Hey, and welcome. Today, I want to talk about value investing in kind of an open discussion way. I'm going to make a 5-part series on how to do value investing. These are strategies I've used for decades to very good success. And it doesn't really matter what kind of stock we're talking about here. This is the way I do the analysis kind of came independently of how people talked about doing value investing. It kind of came from what I learned in the corporate world of how private equity and different entities will do assessments of capital projects and of investment opportunities. And I translated that into investing. There's a few goals I have for this series. The first thing is to really give you the confidence that you can assess any stock. The assessment might come back that you don't know what the heck is going on with this company and you should just avoid it. But at least you feel confident knowing that you should avoid it. You've done the research, done the analysis, and know, okay, we're not going this direction. The assessment, the value investing technique I do, to be very blunt, I've invested for 30 years. I started when I was 8 years old, just to know how old I am. Back then I just kind of picked stocks, and then I, grew up and kind of learned and refined my craft. And really, I've only lost one time, like one time. Now, that isn't that amazing, to be honest with you. The market is always going up. So, I just take that with a grain of salt. But the one time I lost was because I purely focused on the numbers. In particular was Bed Bath & Beyond. And the numbers were great, but the business, I was ignoring the business. I was so focused on just numbers that I ignored the obvious business problems with it. And I incorporated that lesson into my process. And since then, the process has been pretty sound. It's boring. It's not as glamorous as a day trade or as quick, but the consistency is really why you can build wealth with this strategy. It'll feel like other value investment strategies, and we'll touch upon those, how it relates to other value investment strategies that I've read about in the past, including Buffettology, the little book that you can use for investing, better investing. There's so many different value investing techniques. The hints that Warren Buffett has said about value investing, the way Columbia students do value investing. I've heard so many different ways of doing value investing, and a lot of them just are in parallel with the strategy that I've just built on my own over time. The way we're going to break it up is, this is the intro video, and then we're going to talk about the past, present, and future of stock. And I realized just this year that was probably the best way to explain it, because if you can break it up into smaller chunks, then it isn't as overwhelming when you look at the bigger picture of it. One thing for new investors that want to jump into this immediately is, a lot of stock, all you need is the past and present, and you can figure things out of what's going on. So I think that, if you just want to start with the first 2 videos, that's great. The last 2 are going to be much more advanced, full warning. But my goal is to really make all these videos accessible for anyone with an interest in investing that really wants to grow their wealth. And we'll go into the details of every step of what it would take and what I do to do the assessment. There's a reason why value investing is hard, and it has nothing to do with the process. This process is going to be cake by the end. The problem is that when you find that a stock is undervalued, and you know that it's significantly below its intrinsic value, and you have high confidence of that, the market isn't going to reward you immediately for figuring that out. you're going to typically, what I've found through my research is that you really need 2 years for the market to return the stock back to its intrinsic value. In the meantime, if you don't do an analysis like the way I'm going to do it, you also get confused because the intrinsic value is constantly moving. The intrinsic value is going up over time. So what you assessed, last quarter isn't going to match up with what you found this quarter. The intrinsic value of the stock is going up over time, and so unless you see that pattern and trend, you're going to mistaken that your analysis is wrong, when reality is it was right. It's just that the intrinsic value changed. Another thing is if you have a bad company or a confused market, it'll mess up the whole process. It really will. If you're going into a bad company, and bad companies may not be bad in terms of their strategy. It might be bad in terms of that they're confused, that they might be going in too many directions. If you listen to stock analysts on these calls, they really like companies to focus in on what they're doing, because the more focused they are on their core business, the easier it is to do these kind of investment assessments. When a company's trying to do this and they're trying to do that and they're trying to get into this new thing, it just confuses everything and really messes up with the analysis. So if the company is confused, the market will be confused. So nothing will correlate in terms of the intrinsic value and the price of the stock. It'll just go off. I've seen this many times with different stocks that they're just not consistent enough, and they're not actually consistent with the business, and they're trying to go in multiple directions, and the market just gets confused. I think the classic example is Facebook, when they went into metaverses and all that. I think it was a great move. They needed to do something to shake things up. But Wall Street got confused, and they didn't like it. They really don't like that kind of confusion. So just note that when there's a disruption to the company's business, or there's just confusion with either the market or the company, the analysis kind of breaks down because the company doesn't really know where it's going. The other thing that's hard for investors is that sometimes when a disruption to the market as a whole happens, the market won't just rebound back. It's not efficient. A lot of times, the market will take years to correctly reassess investments. The two classic examples is the tech boom and burst in 2000, where I assessed multiple stocks that took a decade for them to return back to their intrinsic value because of just the monumental disruption to the natural market that will pull a stock back into its intrinsic value. The other one was the 2009 market crash, where after that happened, a fundamental shift on how bank stocks were assessed occurred, where there was a different kind of discount rate that the whole market put on banks after that happened. So a new investor will get even more confused because first there's this noise from just uncertain companies, and then even the consistent ones will have these shock waves that will occur because of these big changes in the market. So I want you to note that, because it is hard, it gets confusing, but if you're patient and you wait the 2 years, if you focus on good companies, and you just note that disruptions like COVID, the most recent one, will change the way the market dynamics work around these stocks, you can go in there with confidence with your technique and just accommodate these disruptions to your process. So the final notes I have is, this is a process that's universal to all stocks. It really does work. It doesn't matter if it's a tech stock or if it's a utility stock. It works both ways. You just have to do a little more research on a certain direction you're going to go, mostly in the tech stock, more growth direction. I really want to make sure this video is for new investors, beginning investors, but it will also be helpful for intermediate investors. I think anyone that's an advanced investor, this might be too basic for you, so you can, I'm just being honest up front, but it could be a good refresher for you. For new investors, you'll see that the first two videos assessing the past and present of a company will be very much easier. And if you want to go and test it out on an analysis, it's really good to use these tools for utilities, material stocks, and then some industrials and some banks. You can do these assessments without really thinking too much about the next step, which is the future, and then of course the putting it all together and assessing the company as a whole. That's a little harder to do. Small cap stocks really need to have their future assessed. Tech stocks, their growth and future need to be assessed. Their company as a good business needs to be assessed properly. Healthcare stocks is another one where you really gotta assess the past, present, and future. And finally, I hope you have fun with these videos. I really want you to stay engaged. Hopefully we can have a good time just kind of going through all these analysis, show you some really fun examples of how the market can get really weird on you, and you can go out there and be successful. After each video, I'm going to ask you, please like and subscribe and check out the StockBossUp app, where we try to assess all sorts of different investors in one giant battle royale to see who is the best investor. It's kind of like a mixed martial arts where people can bring in momentum, value, growth, swing trading, whatever they want to do to try to showcase that they are the best investor. And it helps the whole community as a whole because they get to see those top performers' stock ideas and can use that in their own portfolios. So thanks for watching. Check out the links in the description below for the next videos, and I hope to see you in the next one. Thank you.